it's bank earnings season because that's what usually comes first. Steve's got an earnings call that's not a bank coming up, but generally the big banks in the US have been reporting. We're supposed to take an interest in these because they're meant to tell us things about the US economy and how it's doing, because banks are obviously very central to that. They have a good idea on who's borrowing what, who's doing what with that money, and who's struggling to repay it again. So the banks can be interesting. We'll come back to that idea in just a moment, but here's a kind of brief rundown of what's been going on, and you'll spot some similar themes. Let's start with where we were last week. I was talking about Bank of America and trying to convince Paul to buy it. He's since told me it's top of some index or other that neither of us had ever heard of, but make of that what you will. Their revenues came in at 24.66 billion. And that was up 11% compared to a year ago. Their earnings per share were 85 cents, which is up 6% from a year before. They posted a $1.1 billion loan loss reserve, so the money they put aside and don't use for covering loans that have gone bad, effectively. Their net interest income, so the money they make from taking in deposits and sending out loans, was up by 29%, and their investment banking fees were down by about 50%, which is, I suppose, kind of what you might expect in a tighter economic environment. Better on net interest income, worse on investment banking. Brian Moynihan said they were expecting in 2023, I think, a recession of fairly unspecified scale, but I think on the minor end of things. JP Morgan's a similar bank. We'll start with that one as well. Their revenues were up 17% to 35.57 billion. Earnings per share were up 6% to 3.57 billion. Another 2.3 billion credit loss reserve, which was 49% higher than the last quarter. Net interest income up 40%. Investment banking fees down 52%. Jamie Dimon's forecasting a mild recession, but still with quite a bit of uncertainty around that. Let's take those two to start with, Steve. Anything stand out to you there particularly?
Well, it's the environment that we expected to see, isn't it? Net interest income up because rates are up, and that means that banks are charging more for their products that they're loaning out, and investment banking is weighing down on these companies because there's not a lot of deal making going on out there. There's not an awful lot of acquisitions, there's not an awful lot of mergers, there's not an awful lot of IPOs, and there's definitely no SPACs. So all of these kind of anybody with an investment banking arm is seeing some pretty is seeing a drawback in the fees that they're able to attract. In terms of loan reserves, then this is obviously going to be a drag on all of their earnings, so you could theoretically add those back in if you don't believe that we're going to see some massive kind of recession ahead there where they're going to have to draw on these reserves. They have invariably added these loan loss reserves back in almost untouched over the last few years, so there is always a chance that this happens again. Interesting to see that they've both tempered. I think Moynihan was straight on recession last quarter, and Jamie Dimon was forecasting an economic hurricane. So it's nice to see that we have slipped back into mild recession, which is what I think is probably the most likely outcome, even though I have said otherwise in my predictions. But I think that's probably where we're heading. Steve, is anything jumping out of these that I've missed?
No, the point about what you called before a soft landing but now a mild recession, I mean, I view a mild recession as halfway between the kind of landing I was expecting and the soft landing that you were boldly predicting at the start of the year. I guess it's not quite so soft, but a mild recession would be, I think that would be a reasonable exit cost from all of this, to be fair. I would think that Powell had done a good job if he managed to engineer that. I said at the top that we're supposed to pay attention to the banks because they give us a feel for what's going on in the economy. They don't really tell me anything much about this other than doing what I already thought the economy was doing based on the kind of macroeconomic data that I'm familiar with from the US. Okay, interest rates have gone higher. That largely means what we thought it would mean. It's a worse time for doing kind of M&A activity because the debt costs more to do it. It's a worse time for trying to launch SPACs, and it's harder to find capital because buyers are less willing. So fees for investment banking and SPACs and M&A and IPOs and all that kind of thing are down like you would expect, and net interest income is higher, and because there's a higher rate, there's a higher risk of default, at least in some cases, so there's more money being put aside. That didn't particularly educate me. I mean, I don't want to act too smart here because I'll come back in a second to Goldman, which is a bank that did surprise me very much in what should be a fairly obvious way. But I didn't think this really told me anything much about the state of the US economy that I wasn't already thinking was at least roughly the case.
Yeah, and I mean, generally we look at the banks as a bellwether for the economy. So we would look at these and say, if these guys are coming in very light on everything, then we know that, generally speaking, again, the rest of the economy is likely to be suffering in the same sort of way. So it was interesting today to see that that the Davos sort of whatever it is, the hearing or the event is on in Switzerland at the moment. And it was interesting to see that the IMF, they spoke yesterday and said that essentially the world's debt burden has started to drop due to both inflation and the economic recovery from the pandemic. So in a way we are inflating away the debt, which is what inflation kind of tends to do over the long time. It's interesting to see that in the IMF figures that we've gone from 99% global debt to global GDP as a figure over the last, I think that was the last year that was recorded, and it's actually now fallen to 91%. So that is in line with the inflation figures that we've been broadly seeing in the West as well. So it's interesting to see this kind of global economic recovery. Even some of the Euro banks now are coming out and saying that they think Europe will avoid a recession too. So this is potentially interesting times. It would be very interesting to see only the UK fall into a recession, which I'm almost certain is going to happen. I mean, if the Euros avoid it and the US avoid it, we're going to look pretty silly.
We are going to look pretty silly. I think the blame, rightly or wrongly, will go on that mini-budget thing, because that's the main thing that we've done differently to them. The recession, by the way, was cancelled the other day with news that we'd had economic growth in the UK. I don't know if you heard this story.
Point one. Yeah,
point one, because of the World Cup. Everyone went down the pub and spent their money there. I mean, I'm not sure that's particularly going to drive the UK's economy, broadly speaking, but it's good to see people spending money. And I saw that, I don't really like this expression very much, but the consumer in the UK was in good shape. Balances were still kind of higher than they were pre-COVID. So there's still money there to be spent from UK consumers. We just haven't done it yet.
Yeah, and it was interesting that you could see it in. Sorry to jettison off to another point, but I don't know whether you've seen Assos's results that came through as well. They had broadly flat results in the UK and in the EU, and a bit of growth in the US, which you would expect because they're only a small part of a very big market, so that would be quite easy for them to get growth. But it was interesting to see that because you could see the strength of spending in Assos's brand, and off the back of that, everybody thought Boohoo would do the same, but Boohoo came up and said, I think they were minus 17% on their sales, or minus 14%, so it was a much bigger fall. But interesting to see the strength of the consumer in the UK. I don't get that sense from people. Well, I always think January is an awful time for recording stats anyway, because it always seems to be a very long month for everybody. Everybody seems to get paid a week early, and it ends up being a very long month. And, you know, at work at the moment, there's definitely not anybody spending money except me on stupid things like lemon trees. So, yeah, I think it'll be interesting. I still expect we will fall into a recession. No, I don't think we have cancelled it. I think 0.1 with the World Cup on is a particularly bad result. So I guess we'll see on that.
Yeah, worth noting that was only a monthly number as well, and recessions are measured in quarters, so there's still plenty of time for this quarter to finish lower than it started.